Alright guys, warm welcome to another week ahead video. This week's video will cover the trading week running from Monday the 17th of May to Friday the 21st, 2021. Our focus this week will turn to the British pound. As you guys know, we've maintained a bullish bias on the pound, really going back to the middle part of January, where we had that first pushback from the Bank of England about negative interest rates. After that, in terms of growth, in terms of the virus situation, everything is basically just pointed to a positive outlook, positive bullish bias for the pound, and it does seem with recent data points that that bullish bias remains firmly intact on multiple fronts. If we take a look firstly at the growth outlook, the recent GDP data has once again been very encouraging, with March GDP rising 2.1% versus 1.5% consensus. We saw sectors gaining on a month-over-month basis across the board. Construction up 5.8%, services up 1.9%, industrial output up 1.8%. Now, even though quarter one data, that Q1 print of negative 1.5%, even though that was less spectacular, it is important to see this quarterly data point in context. The economy was in lockdown for the majority of the first quarter, and restrictions only started to ease in March. So a drop firstly was already anticipated. And in the light of that, one has to argue that the contraction of negative 1.5% shows that the recovery was even more impressive than initially anticipated. That's part of the reason why the Bank of England, in their most recent policy meeting, actually painted a very clear and positive picture of the growth outlook, projecting that the economy would be back at pre-pandemic levels by Q4 of 2021, where they initially anticipated that only to happen in H1 of 2022. So very positive outlook still in terms of the overall growth picture. Then considering the rates market, back in early January, before we had those negative interest rate comments, back in January, the markets are still contemplating how fast the Bank of England will move rates into negative territory. And now, just a few short months later, the narrative has completely made a U-turn, where the rates markets are now contemplating how fast the Bank of England will actually move to tighten interest rates. If you take a look at SONIA futures on the screen, that's currently implying one rate hike as early as September 2022 and implying a rate of 0.35% by March 2023. So we can see that the markets from a rates point of view is anticipating a possible faster policy normalization compared to that of the Federal Reserve. Some participants, interestingly, were disappointed at the previous policy meeting, where the BOE were very careful to frame the tapering decision as purely a technical adjustment to allow them to, of course, run off their existing fixed purchase program until the end of the year. And even though it wasn't seen as a hawkish tilt, the governor made it very clear in an interview on Bloomberg afterwards that further quantitative easing would only be required if they saw another massive unexpected shock in the economy. So that implies that the bank is confident enough right now in the recovery to not require any further quantitative easing after this fixed package runs out. So that in itself is more of a positive if you think about it that way. In terms of the employment picture, it's also very positive right now. We know that the labor market has been artificially propped up, of course, by the furlough scheme. We know that the current numbers doesn't really accurately reflect the strength of the health or the strength or the health of the labor market. We also know that once the furlough scheme is set to run out in September, that the unemployment rate is expected to move higher, with some analysts pointing between 5.5 and 6% for the unemployment rate. Now, having said that, the recent employment readings we've received has been very encouraging. And it might show that the originally expected hit after the furlough ends might not be as severe as previously anticipated. If you take a look at these graphs, it's from IHS Markit. They noted in a recent report that hiring activity in the UK is currently sitting at a 23-year high, and recruiters noted that they saw the second steepest increase in permanent staff appointments going back to the start of the data collection for this data series. So it's been a very encouraging development in terms of the labor market as well. And of course, the jolt in hiring is thanks to the successful vaccination rollout, which has allowed large parts of the economy to resume regular activity. And as the lockdown roadmap plays out, this trend is something that is set to continue. In terms of consumer spending, we've seen some solid high frequency data. Retail sales has performed really well. We also had Governor Bailey coming out in that same Bloomberg article, or Bloomberg interview, saying that they are seeing very, very strong activity numbers in the recent data, and this trend in upbeat consumer spending is set to keep up and potentially even increase as more restrictions are lifted, but also as households start to spend some of that excess pent-up savings. That's been another big factor for participants who expect that even the more optimistic growth projections right now are actually too pessimistic. If we start to see some of that pent-up savings close to 140 billion pounds according to Capital Economics, if we see some of that starting to really be spent. So the bullish outlook on all of these fronts remains firmly intact as the economy rebounds, and of course as that overall reopening and recovery period gains more traction. So turning to the week ahead, it's going to be a busy one in terms of data points. We've got employment schedule on Tuesday, inflation on Wednesday, retail sales and PMIs, flash PMIs coming up on Friday. Now, there's a couple of caveats, as always, to keep in mind about the data points. For employment, do keep in mind that the data points we get for things like the unemployment rate, employment change, earnings, that's for March data, so a little bit of a lag there. That's why the high frequency data is actually more important right now. But we also have the more timelier claim and count unemployment change, as that is for the April data. That is very similar to the US initial jobless claim. So do keep that in mind. Also, like we mentioned, the furlough scheme is synthetically keeping the labor market supported right now. The report isn't a true reflection of the labor market. When we get to September, of course, the markets will be very, very closely watching the incoming data after furlough support ends. The market is well prepared for a potential jump higher in unemployment after that ends, so just do keep that in mind. However, with that data we showed about that fastest recovery in 23 years, if the current reopening can see faster recovery in the actual jobs data, it could see markets expecting a lesser impact after furlough ends, so that of course can be positive for the pound. From an inflation data point of view, of course, we need to keep the very low 2020 base effects in mind. That is expected to overinflate the year-over-year numbers for inflation, like we saw with the US CPI data point this week. With that being said, that means that the month-on-month data should be more useful to gauge increasing price pressure. Apart from that, it will be important to keep in mind that just like the Fed, the BOE has been very clear that the short-term inevitable rise in prices shouldn't really have any material effect on the medium-term inflation outlook. So even if we do see a knee-jerk reaction in the pound coming off from a much better than expected CPI print, we're not really expecting that to be a real bigger picture or outlook change for the monetary policy. In terms of retail sales, high frequency data like credit card spending, like table bookings have suggested that spending has remained very robust, and it could surprise to the upside, because remember we had non-essential retail opening up their doors from the middle of April. So there is that anticipated, pent up huge jolt in spending that we saw from the middle of April. That is, of course, expected to see upside in retail sales. As for the PMIs, consensus is looking for services as well as manufacturing to tick higher from the prior. The composite measure is expected to come in at 62. So it's a very, very high number. What's interesting about this, though, is that the survey period for the PMIs actually fell within the middle of the first and second phases of the reopening roadmap, and that means that even if we do see a positive number, it might actually not be a true reflection of the current optimism, because it was in that in-between phase. So it will be interesting to see how that comes out. I think what's most important to keep in mind about all of these data points for the week ahead is that the markets arguably won't fixate on any one of them particularly, but they will look at this data in aggregate for evidence whether the recovery is picking up steam, whether we're seeing a further gain in momentum in that recovery, or whether we're starting to see some of that recovery wane. Now, the other important driver to watch in the week ahead is the virus situation in the UK. The vaccination rollout is, of course, pushing on ahead. We've got over 70% of the total adult population at a first dose. We've got close to 40% already on a second dose. And after the successful vaccination rollout, the UK has been able to reopen their economy much faster compared to its peers. We have the third phase of the reopening actually set off to kick off on Monday, where we have most businesses allowed to open as normal. And we also have pubs and restaurants being allowed to accommodate both outdoor and indoor customers. So with everything going so well, why on earth then do we need to pay attention to the virus situation? And that is, of course, the challenge right now in terms of new case numbers that we've seen from that strong variant from India. We've seen those new case numbers from that variant actually doubling in the past week. We had UK Health Secretary Hancock explaining that the government is watching this very closely. And more troubling is that we had PM Johnson warning on Friday that the emergence of the strong COVID variant could actually threaten the planned reopening roadmap and could see the full lifting of restrictions, which was planned for June the 21st, to actually be delayed. So for now, the impact of the variant has been limited, and for now it does seem like the vaccination rollout has kept it at bay. But if the situation escalates and it starts to potentially threaten the reopening, that would be a big negative for the pound and something that we do need to keep a close eye on in the days and weeks ahead. Right, so in terms of a potential trading plan, we're going to keep this very, very simple. We're, of course, watching those key data points like the jobs data, CPI, retail sales, and flash PMIs. For the bullish outcomes, potential bullish outcomes, if we see data points printing above the market's maximum expectations, we'll expect that to see upside in gilt yields, expect that to see upside in pound dollar, downside in euro pound, and of course we're watching virus cases. If we see a significant drop in the new cases from that Indian variant, that should also be more of a bullish outcome for gilt yields as well as the pound. In terms of the potential bearish outcomes, it's just the exact opposite. If we see all of these data points coming in below the market's minimum expectations, that is expected to weigh on 10-year gilt yields, expected to weigh on pound dollar, and expected to see some upside in euro pound. What's important about euro pound is that we need to keep the euro sensitivity to the US dollar in mind. Even though we do still have a downside bias in the medium term for euro sterling, that sensitivity to the dollar has seen the euro gain a lot of momentum recently. So apart from sterling strength, we also need to keep dollar weakness in mind, because if we do see the dollar losing a lot more momentum like we did at the latter part of this week, that can of course create some upside for euro pound, even if sterling strengthens. So that's just a key one to watch in the week ahead as well. All right, guys, so that's everything from my side. I hope you guys will have a fantastic trading week ahead. Remember that the catalysts, everyone that we mentioned is a potential bullish and bearish catalyst on its own, but combined, of course, with others can have a bigger impact in asset price movements. And also remember that the potential outcomes and potential market reactions in this report is merely a guide for what we would expect in the event of these various outcomes. And the markets can always surprise in the way that it reacts. So, the potential impact, the potential outcomes is never intended as a trade call, but rather intended as a framework that you can use in your own scenario planning.